first paper is going to be done jointly by one of our hosts, Juan Castañeda, who will start off and then followed by Brandon Davis. So Juan, you're going to start us off. Over to you.
Yeah. Thank you very much, Charles, for your introduction. Yeah. So, and thank you all very much for your attention. As Charles said, all I'm going to do here is to introduce the topics at the macro level, the topics Brandon is going to develop further later on. So bear with us for the details, because it would be Brandon talking much more on those details. So may I just concentrate on the first part of the question that you have in the program, which is, should the central bank be a bank at all? This may be like sort of a very, I don't know, like an old question to some of you, but I will try to convince you that, especially in the years running up to the crisis, that was not that obvious. Many people thought that central bankers should be just like interest rate setters, bodies, that they were not banking institutions anymore. And that's precisely the point of the point that I would like to make today before introducing Brandon Davis' presentation. So the consensus before 2007 was something similar to what I'm going to tell you now. Regarding monetary policy decisions, well, achieving consumer price stability was said to be at the time equivalent to maintaining financial stability over the long term. So those both objectives were meant to be, ideal to achieve both financial stability and inflation stability. So it was enough for central banks at the time to focus just on targeting a low rate of inflation in order to maintain macroeconomic stability as well as financial stability. That was the consensus at the time. And indeed, if you take a look at the data, the macro data at the time, there was what I would like to call apparent macroeconomic stability since the early 2000s up to the global financial crisis. So, yeah, true, in terms of CPI prices, indeed, we know that central banks did very well and maintained prices, if not below, around 2%, which is fair enough, yeah. But at the same time, we could observe how broad monetary growth indicators, so M2 in the States, M4X here, or M3 in the Eurozone, increased quite notably. So the point is, where did that money go? That was something we were not really ready. When I say we, is academics and policymakers. We were not really ready to address. So one of the problems in the pre-2007 academic and policy world was that, in my opinion, there was a lack of a suitable theoretical and economic policy approach to assess underlying inflationary pressures, those coming from an increasing amount of money in circulation. That was not necessarily taken into account in the strategies developed by central bankers before 2007. And this is an example of the models used in the pre-2007 world that I'm afraid that, unless I'm very wrong, are still the benchmark in macroeconomic policy making. So here you have an extract from a wonderful paper by Lars Svensson, going back to the end of the 90s, in which, again, this is not just a sample, this is mainstream at the time as much as it is now, in which inflation is explained according to the Phillips-Scarf equation, that's the second one, the 2.2 equation there, by which inflation is just related to current output gap and expected inflation. But you won't see here a variable such as the monetary base or even less broad money growth. Why? Because at the time the consensus was that, again, inflation in the short term was very much determined by demand pressures, output gap and inflationary expectations. And you won't see a similar monetary aggregate in the IS function, which is 2.1, which is again the conventional negative relationship between interest rates and output gap. So all I'm trying to tell you is that indeed the theoretical models used to assess inflationary pressures before the crisis were not ready to take into account these increases in money growth before the crisis. And this is just, forgive me for all these equations that I'm displaying here. I promise that I won't get into details. This was the sort of the so-called targeting rule framework in which central bankers were advised to operate. So central banks were supposed to minimize a loss function. In this case, the differences between the deviations between current or expected inflation against an inflation target. Yeah, that was the main target at the time. In order to minimize this loss function, you need to know how your economy operates. So then you have those two equations that I told you about, representing the state of the economy. So all you have to do, well, all in inverted commas, is to solve this optimization problem subject to these restrictions. So you can have in the end, as a result, an optimal path for changes in interest rates. By optimal, I mean mathematically optimal. Those are the interest rates that minimize those deviations of inflation from the target. That's what it was considered at the time as sort of the paradigm, the benchmark we all should follow. Yeah? But again, you won't see here any reference to money growth. And this is really an example of what the models that were used at the time that are still being used massively in academia. And again, just in case you have further questions, I'm more than happy to elaborate in the discussion time. So, in my opinion, this understanding and characterization on how central banks should make decisions left central banks in sort of an institutional limbo, really. So we know anyone who has studied economic history, even just recent economic history, knows that central banks are in the first place financial institutions. But given the theoretical benchmark we gave them to operate in the years before the crisis, they were considered by many, by the specialized media, by policymakers, and some academics, by just interest rate setters. So there is actually an obsession about how much interest rates, how much central banks are going to change interest rates. It's all about interest rates. I'm not saying that this is not an important policy variable, but central banks do much more than that. And this is just a reminder on the other issues central banks should be concerned about. So basically, in the years before the crisis, in my opinion, and please Charles correct me if I'm wrong in the discussion time, the original essential financial and banking nature of central banks quickly faded away. By faded away, what I mean is that virtually there was no meaningful consideration to financial stability concerns. And even, I know that this may sound like a strong statement, but even central banks staff, if not the staff, well, the community of academics studying central banking forgot about the lender of last resort and how to apply it in critical times. This is just a reminder on what the Bank of England has been doing well, since the end of the 18th century. And this is well, a very famous cartoon from the Punch there on, well, the old lady, obviously, distributing Bank of England notes to naughty boys who had been gambling, of course. Those naughty boys are banks, as you can tell. So same old game, it reads. You've got yourselves into a nice mess with your precious speculation. Well, I will help you out of it these ones. So, yes, indeed. I mean, this refers obviously to the Barings crisis in the 1890s. But this is just an example of what the Bank of England used to do, very successfully, may I say, when it was, well, a central bank in the country run by shareholders, basically. So in a fractional reserve system, again, the central bank must intervene in times of trouble as a lender of last resort. And continuing with Tim's remarks in the morning, this provision of extraordinary lending in times of crisis is not a bailout. That's totally different from a bailout situation. This is just a financial support for a solvent institution to keep running its business. We're not bailing out no one here in order to maintain financial stability. And this is crucial. In the past, whenever the Bank of England had to intervene in markets and activated the lender of last resort function, the Bank of England did make a profit. In X years' time, 2, 3, maximum 4 years' time, the bank did report a profit. So it is not that it's going to be always a state-controlled entity absorbing the losses in the crisis. That's not the evidence that we have from previous historical episodes, but just the opposite. It was the central bank making a profit. So if I may say, I'm going to refer to Charles Goodhart's seminal work on the evolution of central banks and some others from Tim Condon. I do believe that we should go back to the pre-crisis characterization of central banks, in which central banks were considered as financial institutions, as banks, providing financial services to the banking sector. Which services are those? I just listed here some of them. Well, credit, both regular and extraordinary credit in terms of crisis, the monetary standard of the economy, hopefully price stability, interbank clearing services, and so on. And in exchange, obviously, if you are providing the services, what you want to do is to keep a close eye on the books of the banks. So why not supervising and regulating the members of the club under the central bank? So this characterization Charles coined very wisely, in my opinion, in the 80s, is still valid now. So think of the central bank as a sort of the key bank of the banking sector, as a club of banking participants abiding by the rules approved by the central bank. And in return, what the central bank does is to guarantee the provision of financial services. In my opinion, and this is something Charles may disagree with me about, there is nothing wrong with a private institution to provide such services. This is Tim Condon's point of view. It's very well known. It's his paper 2009 and others. And it will guarantee, in my opinion, less political interference in the provision of such services, in particular lender of last resort, and much clearer rules for banks to know in advance to what extent the central bank will be providing liquidity to them in times of crisis. So why not moving on to a scenario in which central banks are considered as key players in the market, key banks providing financial services in competition with other central banks?